ask if anyone's got any extra questions afterwards. The idea of today is basically to be as interactive as possible. So we're going to go through various different sections. If anyone's got any questions, we'll take questions on the way through as we cover through the various topics. I should probably say who I am and who we are and why we're here. So I'm Jamie Bubb-Sacklyn, Chartered Financial Planner for Melbourne Capital Group. I've been here in Malaysia for 7 years or so now. A lot of you guys know me, and those that don't. And we've got Neil, who's come over from the Isle of Man, who is Head of Technical Services for IFGL Group. And he'll be helping us today as well, go through any questions and things. So, as I say, let's get started. We do need someone to just press the button to go through. Yeah, do you want to maybe kick off, Neil, in terms of, I don't know, bit of an intro and just genuine changes and things? Yeah, same screen.
Yeah, so good evening, everybody. So I think one of the ideas behind today is to look at the changing tax environment in the UK, what we already know, what things we think are going to happen in the October budget, and ultimately where the tax landscape could end up and the impact that it could have on individuals that have either got strong links to the UK, assets in the UK, or will be taking up residence in the UK, returning there at some point in time in the future.
Yeah, a little disclaimer, we're not tax advisors, so we'll give a lot of information on tax today, but in terms of specific tax advice, we can put you in touch with different advisors in various different jurisdictions, but today is basically information and isn't advice, just a general disclaimer there. So in terms of, I guess, the budget and the Labour government and things that could be changing and maybe are going to be changing, yeah, there's a £22 billion black hole basically. So
yeah, there's I mean, it's a number that for any of you that follow the UK press and papers and etc. But you've got this. Do we want to sit down? Rather than people breaking their necks looking at us. Probably get sick of looking at us anyway. But so there's currently a £22 billion black hole that the Labour government have been very vocal around, and as a result of that, additional revenue is required to deal with all the and also fund the various public services. And as a result of that, either there are cuts to the various services that happen in the UK, or they increase the taxes. It typically only goes one or two ways. The Labour Party don't really have a history of cutting taxes. The manifesto prior to the general election was very light touch in terms of tax increases. The only thing that was made quite clear was the fact that income tax rates weren't going to increase, but they were incredibly silent on every other form of tax. So whether that's capital gains tax, inheritance tax, I guess the two main ones. So that's where I think we're expecting to see changes. At the moment, capital gains tax is a relatively straightforward regime where an individual will pay tax at 10% or 20% on most types of assets, and then 18% and 24% on property. And it's long been rumoured that capital gains tax could potentially increase so that it aligns with income tax rates, which is anywhere between 20% and 45%, depending on the actual gain that's realised. Or there's also a track record for there to be a fixed rate for capital gains tax across the board, so 30% or something like that.
Yeah. So capital gains tax, and we'll go into, I guess, a little bit more detail in a second. That's one thing. I guess another thing which has also been a lot more vocal and well announced is the whole non-dom regime for non-domiciled individuals and how they're taxed in the UK. And that may also have an impact for a lot of people who've been outside of the UK for a long time. And we'll go onto that again in a bit more detail later on as well. Pensions, again, are another thing that there's been a lot of changes, even this year, in terms of pensions, and the lifetime allowance has been removed by the Conservative government. So there's a lot of talk, can that just be brought back in, or could they cap different things? I think basically with all of this, whether it's whatever the taxes are, it's pretty clear that there's going to be some changes. Taxes are more likely to go up than come down. So today is really about just kind of discussing some of these changes, what the impact will be, and is there anything you can do to mitigate some of them. And I get the other one I think we added, so tax tail, which again comes into the changing inheritance tax landscape. So whether you've been UK resident for a certain amount of time, they're talking about making your worldwide assets taxable for inheritance tax, but also if you've been non-resident for 10 years, they're talking about maybe removing you or keeping you for the next 10 years. What they haven't said is what happens to Brits that have been outside for over 10 years already. They definitely haven't said that they're going to be exempted. I haven't seen anything about it at all. So maybe there's going to be a bit of a sting in the tail there in terms of they're still going to capture it. Again, something we'll come on to. And even I think the final one was kind of VAT on school fees. So they're taxing education. And again, it's, taxes are kind of going in one direction. So I think exactly. And it's not just, I guess, a lot of people going to private schools, but it's also special education schools. Those are also going to have extra VAT and things like that. So I guess if we look at capital gains taxes to start with in a bit more detail, I think we have, Do you want to go, Neil?
Yeah, so I think we covered a lot of this before in the intro, really, but there are a number of different taxes in the UK which are presumed to be suffered by wealthy people only. So one is capital gains tax and the other one is inheritance tax. But it's very easy to be brought within the scope of both of those. Capital gains tax, you now have a very low personal allowance, so it's now only £3,000. It used to be a lot higher than that. So for most people that have got straightforward trading platforms, things like that, it's very easy to be brought within the scope of capital gains tax and only have a very small allowance that you can use to be able to offset it. So the rumours are that the rates could be aligned to income tax, which would be significant. So you could see these rates going from 20% for high rate taxpayers up to 45%. There's history for capital gains tax rates to be a lot higher. So what the UK market's currently seeing is that a lot of people are realising assets now at known tax rates rather than waiting to see what could happen in April next year in respect of what those tax rates could be. And one of the issues you have with that is that if you start looking at things like property, for example, then if there's a rush for people to sell property at potentially lower tax rates, then it's going to be a buyer's market. It's certainly not going to be a seller's market. You wouldn't have thought. So it has all of these kind of knock-on effects potentially. You already had capital gains tax introduced for non-residents in 2015 in respect of property. So for anybody that does have UK residential property and is concerned around non-resident capital gains tax, there are calculators that you can find on HMRC's website. These guys, I'm assuming, would help you out with all of that too, where you can kind of plug in the numbers. And it's important to note that it's only the gain from 2015 onwards that's brought within the scope of capital gains tax for non-residents and not the historic gain that's been built up. So if you valued the property in 2015, which everybody was supposed to do, it is possible to get a retrospective valuation. Then you're looking at the uplift on the property since 2015, which would be within the scope of capital gains tax. And then you've got the usual reliefs, allowances, such as improvements you've made to the property, etc., that you can build in to mitigate the gain. But so there's a really useful calculator that you can look at, and it does help people understand what the gain could actually be.
Just on that one, Neil, question we get quite often is, if I was a UK resident when I bought the property, and then I've been non-resident for, let's say I bought a property in 2005, and then I've been non-resident for the last 10 years, and I want to sell the property while I'm non-resident, do I then value the property still from 2015 onwards, or does it still go from when I bought it when I was resident? Does that make sense?
Yeah, I think in most situations like that, then you'd be looking at the value of the property from 2015 onwards, if you were looking for it to go through under the non-resident capital gains tax regime.
Yeah,
I'm pretty sure that if you wanted to, that HMRC would allow you to go back to the start and pay the full gain all the way through. But I think for most people, you'd look to use the most favourable regime that you can, and if you're a non-resident for tax purposes, then you'd look from the 2015 date onwards.
Yeah, and of course, in terms of capital gains tax dies on death. So a lot of people who will maybe hold on to properties, let's say you're inheriting a property from someone who's passed away, the previous gain on that property is erased because potentially it falls under inheritance taxes. So the new value of that property is the value of the property at the date of death. So say if you've inherited properties and you're looking to sell those properties, the baseline cost is the value of the property at death. So the capital gain has disappeared. However, the value at death would have been included for inheritance tax purposes. And that's actually one point which I've seen some articles on recently, is they're saying, should we actually get rid of the death exemption, as it were, and tax that? But then you would have people potentially paying inheritance tax and capital gains tax on properties. I don't know if you've got any thoughts.
No, it's true. Yeah, I mean, you've got to be careful what you wish for, because it's not going to get any easier. And yeah, I mean, you certainly be cautious taking that kind of approach in hoping that it's going to get washed through with another form of taxation.
Does anyone have any questions in terms of capital gains tax, property sales, anything while we're here? Yeah.
What takes priority, capital gains or IHT in your debt?
In this scenario, so the capital gains tax disappears, so inheritance tax would be under currently again right now. Inheritance tax would apply on the value of the property. Inheritance tax is 40% over the exemptions in the no rate bands, whereas currently capital gains tax would be 18 or 28%, depending on your
level of your income.
Level of income.
So where you are, whether you're a basic rate taxpayer or whether you're a higher rate taxpayer. So basically, in a summary, you've got capital gains tax during your lifetime. That's going to apply, and then on death it would be inheritance tax.
Yeah.
And if you decide for inheritance tax, and if you decide to charity, give away.
Well, no, but for inheritance tax purposes on death. So you've got to do all of this stuff before we all leave this earth, unfortunately. And so if you leave a proportion of your estate to charity, so 10% or more of your estate to charity, then you get a 4% deduction on inheritance tax. So yeah, so your inheritance tax rate goes from 40% down to 36%.
So you've got to give it away before you.
Yeah, you've got to plan well in advance and not rely on, my view anyway, and it's my personal view, but you kind of plan rather than rely on allowances and exemptions.
Is that still the 7 year thing?
If you're giving away assets, then there's a 7-year rule. So if you're UK domiciled, and the domicile thing is something we'll come on to later, but if you're UK domiciled and you give away anything outside of small gifts like £3,000 a year for your annual exempt amount, or gifts of things like £500 for marriages and birthdays, then anything above those thresholds, it takes 7 years for the value of the gift to fall outside of your estate. If you die within those 7 years, then some or all of it could fall back into your estate and increase your inheritance tax exposure. So we see it happening quite a lot.
Just to follow up on that question, so basically, say for property, for example, if property is just part of your wealth, you can't say, I'm leaving my property to charity and that's free of inheritance tax. You can't do that. So
No,
they
it can.
value the whole
You
estate.
can leave it to the charity,
Yeah.
but it's restricted in terms of the tax breaks that you'll get on it.
Oh, I see. Okay, so.
So no, you absolutely can, and you will. You can say, I want to leave this property to whoever you like, but its value is still going to be. If you still own it at the date of death, it's still going to fall into your estate for an inheritance tax assessment.
If you give your entire estate to charity, is there still inheritance tax? Or if everything goes to charity, is that
I
exempted?
think you can give everything to the crown, and you might get the slate wiped clean. But yeah,
So basically, if you give everything to charity, then it's zero.
you'd have to look at it.
Trust.
You'd have to look at. Well, trusts are a different thing too. So you can put assets into trust, but then you've still got the same types of rules in terms of gifting. How long you've got to wait for the assets to fall outside of your estate.
Okay, so it's already on that 7
The
£3,000 gift rule you mentioned, is that per person per year?
Per person per year, and you can, if you haven't used it in a previous year, you can roll it forward into this year.
that's per person who's making the gift.
Yeah.
So what you can do, so everyone in this room can make a £3,000 gift this year. If you haven't made it last year, you can make up last year. So you could put 6,000. Moving forward, it'll be £3,000 per year. Is one of the exemptions. Another one is you can give as many people as you want £250, and that's exempted. That the £3,000 I think has been fixed since about 1981. But and if they worked out if you inflated it, it should be significantly higher, but they haven't. Again, it's being capped. But one of the most unused gifts is called gifting from excess income. So let's say I earn £200,000 a year and I only spend £100,000 a year. I can give £100 a year for every year that I have that excess income, and I can give that outright, or I can put that into a trust, and that is an exempt gift.
How does that calculate?
So you basically have to. There is a. So it's based on all of your income, which is earned income, pensions, rental income. Certain income is not included, such as withdrawals from life insurance bonds, but dividends, for example, are included. The way that you actually do it is, again, all of these things only get questioned after death. So there's a form called the IHT 403 form, and that basically, in every year, you can put down your income and you can put down your gifts and your excess. And when the executors of your estate are completing the probate forms, the inheritance tax forms, you've got documented down, this was my income in 2014, this is my expenditure, that's the amount I gifted, and then that gifted amount is exempt.
And that gift of 3,000 has to be given to somebody in the UK?
3,000 can be gifted anywhere.
Anywhere.
Yeah.
How far retroactive is that 3,000?
3,000 is only 1 year, so you can only get back 1 year. 1 year, yeah, per person, yeah.
But
Again.
the income on that's anything
The income is
above and above what you can prove you did
correct. Yeah, so there's basically two rules to it. One is it has to be genuinely from excess income. It can't be from capital. And the second is it cannot impact your standard of living. So you can't suddenly say your general living is £50,000 a year. Suddenly you start spending £5,000 a year. It's had a detrimental impact to your standard of living. So you can't do that in terms of that gifting. Yeah, I think again. Yeah, sorry, go on.
Yeah, sorry, just a question. I think it's you're talking about the gift activity for residents in the UK. So what happens if a non-resident or non-domicile or a foreigner is gifting to someone in the UK who's a domicile? Is that still covered by £3,000? Because for me, for example, if I'm sending to you,
You can make gifts of capital to a person in the UK, and it wouldn't be taxable on receipt.
it won't be taxable.
No, but you have to be careful in terms of when gifts of capital change their nature and are treated as an income. So if you were making regular gifts to a person who was a U.K.Tax resident, then there's only so long before that changes its nature and becomes an income, and then would be taxed as an income. So you can do periodic gifts of capital, typically are okay, but if you were sending the same person the regular payment every month, then it would soon become an income and they'd be taxed on it. Or it would fall part.
That's
That's a different thing for inheritance tax,
Yeah.
yeah.
Yeah, sorry, and just the other point on the gifting from excess income, it has to be deemed to be regular. So that all that means is more than once. You have to show that it's not like a one-off gift. You're going to do it again. So, for example, as I say, if I earn £200,000 a year, I spend 100, I gift someone £20,000 from my excess, or not even that. Let's say I give £5,000 as a birthday present. Next year, I give them another £5,000. That's then deemed as being like regular because it's more than once, so it's exempt. And again, whatever your income is, you can give up all that excess. So if I earn £1 million a year and I only spend 100, I can gift away 900,000 every year, fully exempt from all inheritance taxes. And that gift can go into trust. So we'll come on to, I guess, a bit more in terms of inheritance tax in a little bit later in terms of the whole domicile rule, because that is also changing. But in terms of capital gains for now, does anyone have any capital gains tax questions? Or
There's one more on that
Yep.
question the gentleman asked. I didn't quite
Okay.
get the question. I think it was, if you're a foreigner, you can give a gift to someone in the UK who's a tax resident.
Yeah.
And it might just be subject to their own income tax, is it? Or is that right?
No, it can either be if it's just a one-off gift of capital, then that's fine. It wouldn't be taxable. But if you were to make a regular payment, so the point there that Jamie's talking about. So if you were using, you were making regular gifts out of your income, and that was going to somebody else, and that was a regular payment, then that soon becomes treated as an income. So it's tax-free from you giving it away, but then it's taxable as an income for the person receiving it. So you do have to be careful.
yeah. Again, particularly in the UK, they're looking to tax more things, not less. So there are a lot of exemptions, but generally speaking, they're looking to increase the tax revenue. If we go just onto pensions briefly for a while, then in terms of, again, we're talking about UK pensions here. So earlier this year, the Conservative government removed the lifetime allowance on pensions. So many years ago, there didn't really used to be a lifetime allowance on pensions, and then it came in at like £2.5 million, and then it was reduced to right the way down to £1 million that you could have in pensions without paying additional taxes when you start drawing them down. Then they were increasing it in line with inflation. You could apply for some protections if you were already over the certain limits as they reduced them. The Conservative government earlier this year completely removed the lifetime allowance on pensions, which basically means you can have as much money as you want in your pension without paying an additional tax charge, which was 25%. What they did is they capped the amount of tax-free cash you can take from your pension to 25% of 1,073,000, which is on the screen. So the tax-free amount you can take from your pension is still tax-free cash. The remaining is taxable income. On that point, depending on where you're resident, you may be able to claim what's called an NT tax code, no tax, if there is a double tax agreement between the UK and the country you're resident. Now, in Malaysia, there is a double tax agreement between Malaysia and the UK on pensions. So what you can do is if you apply to HMRC, there's a form you complete, and you basically say where you're resident. You have to get proof of residency from the Inland Revenue here, and you can get given an NT tax code. At that point, because of pension freedoms in the UK, you can draw down your entire pension from the UK with zero tax in the UK. And then you have your pension in cash, basically, with you in Malaysia if you're here, and then you can do something else with that, but the pension's fully removed from the UK system. Now, again, currently, pensions are exempt for inheritance tax. So a lot of people would actually draw down their pensions last if they're subject to inheritance tax. Because if I've got assets in my estate, which are gonna be subject to inheritance tax at 40% when I die, then my pension is exempt. Why would I take money from my pension? I would spend all the money in my estate first, currently. So removing your pension from the UK gross of tax could remove it from the UK, but it brings it into your estate for inheritance tax purposes. So again, there's kind of lots of planning needed around that. But the lifetime allowance could easily be brought back into place by the Labour government, in which case suddenly you could have had £5 million in your pension, But actually now, if they bring it right down again and you start drawing money from your pension, it may be subject to lifetime allowance taxes. And that's, I believe, regardless of having an NT tax code. Yeah. Yeah, so do you have anything on pensions?
I mean, we've already, I guess, saw kind of stealth taxes be introduced in respect of pensions over a number of years, with beneficiaries of pensions paying tax depending on how old the member was or is whenever they pass away. And then in conjunction with the lifetime allowance being removed, it hasn't really been removed. It kind of still sits there in the background and is used for lots of calculations depending on how much of an overall pension pot people have got, and how much someone's allowed to inherit without paying any tax at a personal level. So there is kind of already a level of stealth tax on pensions on death.
And again, in terms of the death benefits for pensions currently, so if you pass away before age 75, the recipient of the pension can receive the entire pension without any inheritance tax, or without any income tax implications on that person who's receiving it. So if I pass away today and I'm under 75 and my pension is exempt from inheritance tax, my beneficiaries can draw that entire pension out without any tax implications, even if they're in the UK. If I pass away post 75 and then I receive an income from that pension as the beneficiary, that pension is taxed at your personal income tax rates as the recipient. So again, these are all currently in place. It would be quite simple for the legislation to change again and say, actually, the death benefit of that pension is now taxable on the recipient if you're under 75. So again, and the other thing, I suppose, in terms of pensions, maybe less relevant for a lot of people here, but contributions into pensions are currently very tax favourable. So if you're a UK resident, it makes sense to put as much as you can into your pension because the contributions are net of tax, or gross of tax, sorry. So the money you have going into your pension is non-taxable. So a lot of people fill up their pensions in the UK each year, putting in as much as they can because they don't pay tax on the way in, they pay tax on the way out. Again, there's a lot of talk at the moment. If you're an additional rate taxpayer, you're getting a 45% tax relief on the contributions going into your pension at the time. So another change which may come is that they may remove some of those allowances or reliefs and start taxing people on the way in. Probably less relevant for most people here because if you're here, you're probably not contributing to UK pensions. But if you've got people in the UK that are, just something to bear in mind.
Yeah, I mean, that number, 22 billion that was on the first slide in terms of the black hole, you'd wash that away very, very easily by restricting higher rate tax relief on pension contributions. It would just go, I think it's 50 billion, I think, is the tax cost for tax relief on contributions into pension schemes.
I was reading that. That's all they have to do, actually.
Yeah.
To do one thing, that's all they have to do.
Yeah.
Yeah, it would probably significantly reduce, well, it would reduce the amount people, I guess, would put into their pensions. But I guess the argument is if you're paying additional rate taxes, you've probably got other investments and assets. But yeah, that's a simple thing. Any questions in terms of pensions? Anything else pensions wise? No.
One thing for me is,
yep.
So as much as we love living over here in Malaysia and being overseas for a long time, when that time comes to go back to the UK, if that happens, what's your views on gaps in national insurance contributions, and how is that going to be covered by the Labour government if that changes? Okay.
Yeah.
I mean, at the moment, you can make up shortfall in national insurance contributions to get a full pension whenever you go back. So that's something that you can do. The one thing that is less clear, I think, for all of us at the moment is the direction of travel in terms of what a Labour government may or may not do in terms of allowing full access to benefits for people moving into the UK going forward. Let's say at the moment you can still top up your national insurance contributions, and enable yourself to receive a full pension whenever you go back,
And I think
if you go back.
I think in terms of UK state pension and national insurance contributions, so there's two types of voluntary contributions you can make. Class 3 contributions, they used to be about 800 and some, they were like £15.45 a week. Those ones keep going up a bit. Or there's class 2s, which if you've been working abroad, you can pay the lower amount, which is like £3.45 a week, and you can make those up going backwards. What, again, right now, if you are close to, the state pension used to be payable from age 60. And then it moved to kind of 65, 66, 67. It's definitely going to 68. It's probably going to keep going higher. And there's also a lot of talk about the state pension becoming means tested. So if you've got other assets or other income, they're already talking about reducing the amount of state pension you can receive if you've got other assets. So again, depending on, in my opinion, I mean, personally, I'm not paying national insurance contributions because I don't believe there'll be a state pension by the time I'm 75 or further. But if you're within, I would say if you're within probably 15 to 15 years, maybe slightly more of state pension age, right, like as an advisor, it makes sense right now under current legislation to get money into it and get as much from it as you can. In Malaysia, if you're receiving it, it doesn't increase when it becomes in payment. So there's many countries in the world where your state pension does increase with the triple lock. Malaysia's not one of those. So once it begins payment, it's fixed. If you go back to the UK, it starts increasing again. But, and again, no one knows what's going to happen in the future, but it's looking more likely that they're going to start means tested it. So even if you get 35 years worth, and by the way, you used to need to have 30 years. So you used to need 30 years and it pays out at 60. Now you need 35 years and it pays out at 67. So again, it makes sense to have as much in there and be entitled to the full amount right now, but that full amount may change. So again, as an advisor, my advice is always, if you can add money to get a guaranteed government-backed pension, yes, it absolutely makes sense under current legislation. It could always change.
Is it still correct that you got until April next year to get 16 years back payments?
Correct, yeah. They extended that one previously, but yeah, you can make back
16 years.
Only up until April.
Up until April next year, yeah. And again, even in terms of making that contribution, there's the class 2s or class 3s you can make. So the standard one they will tell you to make is obviously the higher amount, which is like I think it's even 900 and something pounds a year now. But there is a form to complete which says, I've been working abroad since these years, I would like to claim class 2s, in which case it's a much lower amount to pay in, even for those previous years. But right now you can make those up until April next year.
I've gone through that process for my daughter.
Yeah.
She lives in Dubai.
Yeah.
And it is a hell of a problem.
Yeah, HMRC are notoriously slow at getting back to you.
Yeah, we've pretty much done it.
Yeah, there is now, you can now do it online. They've actually got a like a workflow online on the website, which you can go through. Doesn't mean they get back to you straight away, but you don't have to call them up. I think you still have to post letters in some instances. Yeah. Yeah.
Okay, so I'm not sure I've done this right. I'm not taking my pension at the moment.
Yeah.
The basis that I won't get
Yeah, the increases.
the increases.
So you can't, yeah, okay.
As soon as I go back to the UK, I can.
Okay, so yeah, exactly. So for the state pension, if you are already at state pension age, you have two options. You can take it or you can defer it. If you opt to defer it, it increases the amount you receive by, I can't remember the exact figure, it's about 9% a year. It's like 1% for every 9 weeks. Opt.
I actually got to take an action to do it.
You have, no, so you,
Automatic.
so
I don't draw it.
if you don't draw it, yeah, it can be automatic.
But if I go back, then
Even if you're here, you can receive it.
I can receive it.
Yeah.
And then,
When you go back,
so
it will
for
start
1 year or two, I
increasing.
go back. So for 1 year, it doesn't advance.
Yeah.
When I go back,
Yeah, it will
I
start
then
again.
join with everyone else.
Yeah.
So it's-
Yeah.
it's-
So right now, the full state pension is like £221 a week. And actually, we've had 2 years of very high inflation. So it increased by like 10.1% 1 year and 8.7% the next. But if you were here, it would have been frozen that whole time. As soon as you go back, it will start increasing again in line with the triple lock in the UK. Yeah, Gordon, sorry. Yeah.
There is one thing to note, that if you are claiming back all your pension allowance, your national insurance contributions, and you do go back, you're not entitled to any of the other old age pensioners' allowances, because you haven't been, although you paid into your national insurance, you don't get like the cap, well, winter fuel allowance.
The winter fuel allowance, which is about to get canned.
But any of the
Yeah.
other allowances, you don't get.
Yeah. Yeah. Okay. That's good. So, in summary, I guess, Alan, under current rules, it makes sense to make up those missed years because it is a guaranteed government-backed pension. However, the rules can change. The goalposts have already changed a number of times, and it could become means tested. So, if you've already got other pension income, then they may reduce the amount of state pension you're entitled to.
Any insights into I think it's 2026, Malaysia want to try and reintroduce tax on foreign income?
So yeah, again, in terms of currently in Malaysia, you don't pay any tax on foreign sourced income. The whole backstory to that one is that back in 2021, the OECD were going to put Malaysia on the grey list, basically because in Malaysia they weren't taxing foreign sourced income, and it wasn't in law, or there was no legislation for it. I mean, if you're in Singapore, if you're in Hong Kong, you don't pay any tax on foreign sourced income, but in law it's taxable. They just exempted it all. So what they did in Malaysia is they introduced a new law which says we now tax all income. However, for the next 5 years, for an individual, we'll exempt all income. So that runs until December 2026. Again, no idea what they're going to do, but I'll be surprised if suddenly they started to tax everyone, because a lot of the people in Malaysia are here because of some of those exemptions. So of course they could change it, but realistically in Singapore and in Hong Kong, they don't do it. So my opinion would be they would probably just extend that further. Although of course, now it's in law. I mean, take Singapore as an example. Inheritance tax in Singapore it's actually in the law. In Singapore, there is inheritance tax. It's just taxed at 0%. So yeah, so the law is there, and most, in terms of like the OECD, they look at the law, not necessarily the rates. Of course, they can try and impose the rates further on down the line, but the law in Malaysia is now there, whereas it wasn't before. The rate is now, well, it's just been exempted. So I think it's most likely they will extend the exemption, but of course they could change it and implement some taxes there.
So just to add on that, I don't know if it's right, but that again is taxable only on a remittance basis, even after 2026.
Yeah, remittance.
So remittance. So if you don't remit into in Malaysia,
Yeah.
then it still stays as non-taxable as of now.
In fact, the rules are right now that even if you bring money in now, if you're a tax resident here, if you're not, it's all right. If you're a tax resident and you have a TIN number, right, then any money you bring into the country from overseas, you are technically supposed to declare it on your income tax return. It's not chargeable.
You should declare it.
But you're meant to declare it. So they're building up a pattern so that in 2026, if they do implement it, that pattern will show, whether this guy's been honest or dishonest. Because they know what you're bringing in anyway. If you transfer
how much
money,
money they can make if
sorry?
It'll also give them an idea of how much they can make by changing the rules. They see what people do.
That's all. They'll see what you can do. And they'll be this person's been lying for the last 5 years. How's it been eliminated?
Well, that's already they've already got that information. Because there's an initiative that was brought in by the OECD a few years ago now, 2017, the Common Reporting Standards. So any financial account that you hold outside of the jurisdiction where you live, that financial account provider every year by law has to send information to its local tax authority or directly to the tax authority where the individual is a tax resident.
Probably CRS.
Yeah, so the Common Reporting Standards. So tax authorities have already got this. And it's like you say, that it's very easy if you're a poor country, and you look at what's been brought into the country without you taxing it, then you don't have to be a genius to see what the writing on the wall and which way it could go.
And
So currently here, if you bring in the proceeds from the result of capital, so
That's okay.
that's okay.
Yeah.
You have to, I mean,
Yeah.
it's still supposed to declare how much money you bring in.
Yeah.
And put down what it's for.
And the same for, so HMRC now are also issuing letters to people and basically sending letters out saying, we understand you have some foreign income or gains. So this is for people who are resident here in Malaysia. Sometimes you will get a letter from HMRC, even addressed to you here in Malaysia, saying, we understand that you have recently realized some income or gains that has not been declared on your UK tax return. If you've got a tax return, let's say you have rental property, and they give you like 4 options. Either you should have paid it, should you have paid tax on it, or I think option number 4 is I've not declared it because it's not taxable in the UK. But even HMRC are now sending letters to people who have to submit tax returns to say, because there's an automatic exchange of information. So if you've got an investment account in the Isle of Man as an example, and you sell assets and you make a gain on them, that information is sent from the Isle of Man to the UK, and then the HMRC are now saying, oh, is there any tax due for us on that? Even if there isn't, you just have to tick a box to say it's non-taxable. But they're coming to you asking again. They're asking the question. So, yeah, it's again, the automatic exchange of information is there. You can't really shield or hide these days for anything on that basis. Any other questions at the moment while we're on that one? Is everyone also, I guess while we're here, is everyone okay for drinks? If not, is there anyone around? Put your hand up if you want an extra drink. Okay. Yeah. Yeah. Okay, so I suppose moving on to inheritance tax in terms of the UK. So as you'll see on the screen, the inheritance tax take in the UK is going up every year. I think last year £7.5 billion was taken in inheritance tax. And a lot of this is due to the nil rate bans being frozen for many, many years, which means more and more people are getting into the scope of inheritance tax. The rules are not in law yet, but are about to come into law in terms of residency and domicile, which I think we'll probably go into in quite a bit of detail now. Yeah, maybe hand over.
Yeah. So inheritance tax at the moment is based on domicile, concept of domicile. So if someone's got a UK domicile of origin, or they've acquired a UK domicile of choice, or if they've been in the UK for 15 out of the last 20 years, then their worldwide estate is brought within the scope of UK inheritance tax, with a levy of 40% on amounts above the nil rate band, which is £325,000, which hasn't increased for as long as I can remember, and wasn't due to be reviewed for at least another 4 or 5 years. I think it's very unlikely that will change any time soon. Domicile, though, has always been one of those subjects where some people were okay with planning around it, and other people would get caught out. It's a bit like the residency rules that used to exist in the UK before the statutory residency test was brought in, many years ago now, in that people were never quite certain whether they were in or out of scope, and as a result of that, there were a number of people that were caught out. So you had people that had ceased UK residency, but hadn't done enough in the eyes of HMRC to properly cease. And therefore, even though they weren't resident in the UK anymore, their worldwide income and gains were still subject to the UK tax system. So loads of these cases went through the courts, and we ended up with a statutory residency test now, where it's very easy to kind of set out your own personal circumstances and determine whether you are in or out of the scope of the UK tax system, certainly in respect of income tax and capital gains tax. For inheritance tax, though, on domicile, it's always been a really odd odd topic and sometimes very difficult for people to demonstrate that they've been able to significantly or properly sever all ties with the UK and therefore lose their scope to inheritance tax. But that's all about to change based on what we know so far from the announcements made by the Conservative Party and also the practice notes that were released by the Treasury prior to the general election. And our understanding through various industry groups is that HMRC and the Treasury are still pressing on with this residency-based inheritance tax system now, as opposed to one which was linked to domicile. Now, it's always been possible to change your domicile, acquire a domicile of choice in another jurisdiction. So, provided you could set out that you've achieved a settled objective in the new country, that was now your kind of centre as far as your day-to-day activities, and that's where the average man in the street would view you as living. You could set out that you'd acquired a domicile of choice in another jurisdiction and make sure you documented it properly, because remember, you weren't going to be the one that's going to be around to argue your case, it was going to be your executors. So it was always important to set out why you viewed yourself as no longer being UK domicile. But that could be a benefit of the way that the tax system is going. So the UK apparently, but we have to wait and see what happens in the budget, but are working towards a residency-based system now for inheritance tax. So for anybody that hasn't got a UK domicile of origin, so wasn't born there or hasn't acquired domicile of choice, then at the moment they can live in the UK for 15 out of the last 20 years without their estate being subject to UK inheritance tax.
And by estate, that's worldwide assets.
Worldwide
as well.
assets.
Yeah.
UK assets are always within the scope of inheritance tax, so yeah, it's an important point. But for 15 years, inheritance tax wouldn't apply, only on assets that were in the UK. That's about to change now, because the non-domicile rules, which that was part of, are about to largely be repealed, scrapped, in that anybody moving to the UK for the first time now, after 10 years, their worldwide estate would fall within the scope of UK inheritance tax, not just their UK assets. And also, they would no longer be able to claim what's referred to as the remittance basis of taxation, where, again, for up to 15 years, you can keep your non-UK income or gains outside of the scope of the UK tax system by claiming the remittance basis of taxation.
So, Rishi Sunak's wife, basically, this is where a lot of this has come from, though. Yeah, because she was receiving hundreds of millions of dollars worth of dividends outside of the UK, and she was paying the remittance basis in the UK, which is where you pay fixed amount, and then everything else is outside. So that's where a lot of this has come from. And now, after 4 years rather than 10 years, you said 10 years. But
so what somebody could do at the moment, and what Rishi Sunak's wife is doing, was claiming the remittance basis of taxation, where depending on how long you've been in the UK, after a certain point in time, in order to keep your non-UK income and non-UK gains outside of the scope of the tax system, you have to pay a tax charge. And that started off at £30,000 a year, where you've been UK resident for 7 out of the last 9 years, and then that extended to £60,000, where you've been resident for the last 12 years. And that's what a lot of people do. So as long as the numbers make commercial sense, which they definitely do if you've got hundreds of millions of dollars worth of dividends being generated every year, then £60,000 a year is absolutely nothing to protect all of that. That regime is going to disappear, in that first-time arrivers typically into the UK will only have a 4-year period where their foreign income and gains can remain exempt. There won't be a tax charge to pay anymore, but you've only got that 4-year period. If someone's already there and claiming the remittance basis of taxation, so let's say they've been there for 3 years, then they'll have 1 year that they'll be able to claim that exemption. After that, then they're treated in exactly the same way as a long-term UK tax resident, in that the worldwide income and gains are subject to income tax and capital gains tax on an arising basis, and not when they're remitted into the UK.
So this is about people who live in the UK and claim non-domicile.
Yes.
Yeah.
But for non-domiciles outside the UK, how are we?
For non-domiciles outside of the UK, that's the flip
You
side.
mean non-resident or non-domicile?
Well, that's what I'm getting to. What is the diff? You know, I mean, you just said it's moving back towards a residency-based
Yeah.
system.
So a residency-based system gives you more clarity. So when you look at the statutory residency test, where before that you had to look at, you know, a rule that people worked to was providing I don't spend more than 90 days a year over 4 years in the UK, I'm not subject to tax. That rule never actually existed. It was only ever guidance, and lots of people got caught out by it, which is why it led to a number of cases going through the courts and finally ending up with the statutory residency test, where it clearly sets out how many days you can spend in the UK each year when you combine them with your connecting factors. So whether you've got a home there, it's your only home, whether you've got dependent children there, spouse there, all of these other things are all taken into account now. It used to be that HMRC would look at the number of days together with things like, have they still got a UK bank account? Have they got golf club membership? You know, the high profile cases, one in particular where they looked at, you know, if you attended horse races in the UK, whether you had private member club membership, all of these kind of things. That was all scrapped. And now we've just got the statutory residency test, where it's very clear as to whether you're resident or not. And that will align itself now with inheritance tax going forward.
And
So
that's on the government website is actually a very good tool.
it's really easy.
I check every week.
Yeah.
Because you know where you're going. Never need to be resident there. It's a very good, and you can
Yeah.
put hundreds of different scenarios in there
Yeah.
to suit what you think you might be going to do. Yeah, so it's very
So, do you have a question now?
On that subject, so when myself and Carol left the UK many years ago, we relinquished our right to vote, but in I think it was just the last couple of years, expats could vote. So
Yeah.
we registered ourselves. Does that then make us?
No.
Yeah.
We're now a domicile.
No. It's from a residency perspective, it's 100% clear that anybody can look through a test. Lots of financial services businesses just have a straightforward flow chart that you can look at, or you can look at the one on HMRC. You've got one which goes into even more detail, and that will set out. It'll tell you how many days you can spend in the UK each year. Whether you're an arriver, first person, whether you're going in having not previously been tax resident before, or whether you're someone that's been resident there previously and left and is still going back. It's very clear cut and straightforward.
But from a domicile basis, so domicile again goes back to if you were born in the UK, you're automatically UK domiciled at birth. There is a huge list of things, and one of them is like vote. I read it. One of them is voting for a political party could be deemed a tie back to the UK. So under current rules, choosing to vote in UK elections could be deemed a tie to get you back in under domicile under current rules. However, it's not enforced yet, but it's very clear that they're going to move away from domicile and get away with this confusing are we not, and move towards the residency basis, which says if you've been resident in the UK for 4 years, your worldwide assets are going to be subject to UK inheritance tax, and that's going to remain the case for the next 10 years after you leave. Although one thing they haven't said yet, well, they've said it's going to move to a residency basis, but what they haven't said is what happens to UK domiciled individuals who've been outside for more than 10 years. And I think, to me, that's one thing which, again, there hasn't really been any chat on it, has there?
It's been completely silent. But if we kind of look at what's kind of happened in in previous kinds of scenarios before. So personally, I'm quite sceptical as to whether or not someone that's been formally domiciled in the UK will be able to go back and claim the 4-year exemption for foreign income and gains to remain outside of the scope of the UK tax system, and also be able to protect their estate for up to 10 years against UK inheritance tax falling due. But you don't know, it could, but I'm sceptical that they'd allow that to happen. And the reason for that is that another area of planning that's always been really popular with non-UK domiciles moving to the UK for the first time was something called an excluded property trust, whereby You can put non-UK assets into a trust structure as a non-UK domiciled person, and those assets will remain outside of the scope of inheritance tax even after you've lived there for 15 years, and your other assets outside of the trust are brought within the scope of the tax system. So excluded property trusts are going as part of this whole regime anyway, but there is a bit of a flurry at the moment for people to try and get them in place before April, on the basis that the rules aren't going to be retrospective. But that's a difficult position to comment on.
Again, we don't know right now. So currently, if you are non-domicile and you have money in an excluded property trust, I've helped many people set them up, and you go back to the UK in the future and live in the UK, everything inside of that trust will always be outside of the scope under, again, current rules. They've said that they're going to get rid of those trusts for people moving to the UK from April 2025, but what they haven't said is whether existing trusts will be exempted. And I mean, they could, of course, bring those into the scope of inheritance tax, but I think we're already seeing people talk about leaving the UK, and if they bring in existing trusts that were formerly exempted, in my opinion, more people are less likely to go back to the UK again. But right now, we just don't know.
Yeah.
But yeah, as Neil says, there is a bit of a flurry of people looking to set them up, because the most likely scenario is if it's already in force, they will exempt it moving forward, but new ones won't be allowed. But again, this is for non-domicile people going to the UK in the future. I think the biggest question for most people here is going to be, if I've been outside of the UK for 10 years, am I now outside of the scope of inheritance tax? Right now, under what they're saying, it would imply, yes, you're going to be outside of the scope. However, they haven't said that. And they particularly haven't said it for, I guess, UK domiciled individuals, which most people who are born there would be. So all of this is just being completely silent. You would hope that, well, I mean, most people in here would hope that they do use that residency basis, and then if you've been outside for 10 years, you're outside. However, even if they do that, probably if you go back, you might not get the 4 years, as Neil says. Maybe as soon as you go back and become resident, you're fully inside again. So again, it's very, very unknown. And I don't know, it seems that there's deliberately not been any talk on it.
Everyone's been very, very silent on it. It was kind of a bit of a rushed proposal anyway, by the Conservatives leading up to the general election to try and steal some of Labour's thunder. So Labour would say non-dom position is terrible, we can't allow this to happen, it needs to change, so on and so on. And then the Rishi Sunak example. So the Conservatives put this proposal in leading up to the election to steal some of the thunder, but it's like Jay says, it's very silent in terms of what it could all mean going forward. At the moment, you could be UK domiciled, and you could leave the UK, sever as many ties as you can, and acquire a domicile of choice in another jurisdiction. And your exposure to the UK tax system, in particular inheritance tax, would fall away after 4 years, as long as you maintain that domicile of choice in the other jurisdiction. There's a twist with that, and then if you move to another country, then you reset your domicile of origin again, so that catches people out. But under the proposals, then rather than being able to acquire a domicile of choice after 4 years and lose your exposure to inheritance tax, you're going to be tied in potentially for 10. So what it does is it brings non-UK people into the scope of the UK tax system faster, so reducing it from 15 years down to 10, and potentially down to 4 for income and gains. And it also ties people into the tax system for longer after they leave, whereas before you could sever all ties for income tax and capital gains tax the following tax year, and then for inheritance tax after 4 years, by losing your domicile. And those exit taxes, for want of a better phrase, being tied into the system are going to stretch out significantly longer.
Yeah, I think one.
Sorry, yeah. You're saying that domicile in UK for individuals born in UK, there is no clear situation at the moment.
Well, there's HMRC don't give you a checklist in terms of the steps that you need to follow, if that's what you mean. But there are steps that you can take. So if and again, this isn't personal advice. Just have to caveat that. But if you've got an individual that's left the UK, they've moved to another country, they're allowed to remain in that country, whether that's through a visa program or whether it's through some kind of citizenship scheme, acquiring citizenship. And they are able to demonstrate a settled intention to remain there. So the average man in the street, when they look at your personal circumstances, would say, well, you're not UK domiciled anymore. Maybe you left 10 years ago. You've been in Malaysia since then. You've got a home here. Your family are here. You work here. So you've acquired a foreign domicile of choice. Then you can set those steps out that can be used by your estate to be able to demonstrate that you lost your UK domicile of origin and have acquired a domicile of choice in another country.
But what I've seen and what investigations I've done, there's no way to change domicile.
There's no.
You won't get a letter from HMRC saying we accept you are no longer UK domiciled.
The question is, there are, as you said, so many scenarios that you've got to consider.
There are.
I mean, you've mentioned some that I've not even heard.
And the biggest one is, the biggest one is if you, let's say I've been outside of the UK for, let's just use me as an example right now. I've been outside the UK for 7 years. If I sever all ties to the UK and say I'm going to remain in Malaysia for the rest of my life, I want to acquire a domicile of choice in Malaysia, I can do that. But if I then leave Malaysia and move to Thailand, I go back to the UK in terms of domicile. So even if I have my intention forever to be here and I go and live somewhere else that isn't the UK, I automatically go back to the UK domicile. Yeah. Currently, again, all of this is about to change, and probably for a lot of these reasons where it's so ambiguous.
That is if you have an English passport.
Passport doesn't matter.
Where you were born.
Yeah. So you
Take my situation. Northern Ireland refused the British passport.
Born in Northern Ireland, but have an Irish passport. Okay, yeah, I would say
your passport it can link you back to the UK in terms of domicile challenges, but you've got to look at your personal circumstances, the facts around yourself in terms of whether or not you've retained a UK domicile or that you had from birth or through your father, or whether you've acquired a domicile of choice somewhere else. So a lot of people think, we come across them all the time where they've given back the UK passport and they've got a passport from somewhere else. Or the fact that they've retained a UK passport, does that mean that they're still UK domiciled? It's a factor that can be considered, but you've got to look at the personal circumstances around the individual in terms of have they undertaken sufficient steps to leave the UK behind them or not, or have they still retained that UK domicile? Have they never lived long enough in another country to acquire a domicile of choice, which happens to lots of people. They're just transient. And they've never set down roots. So they could have left the UK 50 years ago, but never spent long enough in one place for their executors to be able to demonstrate a settled intention to remain there. So passports, etc., can be an indicator, but they're not the defining thing which would set out someone's domicile.
I'd say what's reasonably clear is that if they do move to a residency basis, and if you remove all assets from the UK, it's more likely that you're going to be outside of the scope in the future. Basically, if you've got any assets in the UK, they're always going to be subject to UK inheritance tax, and that's always going to give you a tie. Even if you've got, so property is an obvious one, but if you've got an investment account which is actually based in the UK, even if you're not paying capital gains tax on it because you've been outside for a long time, you may pay some income tax on dividends generated, but that asset is in the UK. To me, it doesn't make sense to keep it in the UK when you could put it somewhere else. The Isle of Man, Singapore, anywhere else outside, that would remove a lot of that from the UK. And again, there are, I think for most people, if you have intentions and you're putting plans in place and making use of gifts and whatever else, then you're sort of showing the steps you're trying to take to remove it. But this is going to change things quite significantly for everyone here and people looking to go to the UK in the future. As I say, Right now, we don't know exactly what's going to come out. I think in the papers that Labour put out, they did say they were going to consult the community, tax advisors and others. And I think we've probably all seen articles of however many thousand people are looking to leave the UK. And I think if you look at some of the figures, some of the rules they're looking to bring in may end up meaning they'll take less tax over time, because most of the tax revenues in the UK come from the higher and additional rate taxpayers. I think it's 100,000 people pay like 50% of the income tax in the UK. So it doesn't take many of those people to leave for the tax revenues to go down. So changes are coming. We definitely know they're coming, and there are potentially planning opportunities, but we don't know exactly what they're going to be. Just kind of, we can prepare, I guess, in advance.
Yeah, we'll know on the 30th of October.
30th. The budget is the 30th of October. And again, we don't know when they're going to make these changes come into force. So capital gains tax, they could say from the 30th of October. Now, suddenly all the rules change. It's probably unlikely they'll do it for the domicile status to residency, because there's probably a bit of legislation they need to put in place. So that's probably more likely to be April next year. But certain things could come in as early as next month.
So if you are then non-resident or non-domicile at death, right? If you are, then IHT doesn't apply. Is that correct?
Yeah. So if they move to a full residency basis and you've been non-resident for more than 10 years and you have no assets in the UK, if all of that goes through, UK inheritance tax would not apply to your estate.
And then therefore, would that, the people who get the money, like your kids or whoever they are, would that be then taxable as a capital gain or income, or is that free of that as well?
At the moment, and this is an important caveat, at the moment, then after the estate's gone through the inheritance tax assessment, then anything that's passed on after that, even if there is inheritance tax due, is tax free in the hands of the recipients. But there's again another rumour of a potential gift tax.
That's why I asked.
Yeah.
And also, if you give anything that gives an income, that becomes taxable.
The income would be taxable.
The income
yes,
would be
if they receive a property, for example, and it's got rental income, the rental income is obviously taxable.
Okay, but at the moment it's still.
But there is again other potential things that have been talked about. Gift tax is one. Another one is I've seen some things on is an exit tax. So they already apply this to a lot of some countries. South Africa is one where if you want to remove yourself fully from the system, you pay tax up front in order to get yourself out of the system. So there's not been a lot on this, but again, that's something else they could say. Okay, fine. All of everyone who's been outside for 10 years, you can be outside of the scope, but if you're originally British, you still got to pay some tax to be outside, potentially. We don't know. Yeah, again, it's unknown, but it's done in certain places, or many countries actually.
Yeah, America's a popular one.
America, yeah, or if you go, yeah.
That's only if you buy a new passport.
If you're going to expatriate yourself.
If you give up your US passport, you have to still pay taxes for the next 3 years after you leave, I believe.
They
pay tax on worldwide
gains that they haven't realised.
Yeah, unrealised gains tax, as well.
Yeah, it's nuts.
And again, they could go the other way, and they could do what the Americans do and just tax Americans anywhere on worldwide assets. We don't know. It's again, will be unpopular, but who knows? Yeah. So.
If you want to become, if you want to relinquish your domicile in the UK, become domicile in Malaysia, those who are here long term, you have to get your residency here, and getting your residency here is very difficult.
Well, I think residencies are about tax.
As in permanent residency, or so?
Yeah. To become domicile in Malaysia and show that to the UK, you have to become resident here.
I think there's two things there. I think one is I guess being domiciled under like Malaysian type law, where having permanent residency and citizenship, same as other countries, achieves that. But in terms of losing your UK domicile, it isn't strictly necessary for you to have the ability to remain indefinitely in the country. So you could be living there under a visa program that has to be reviewed every 12 months.
So you could be a nomad.
You're not a nomad. No, as far
You'd still need some kind of visa to be here. So MM2H, talent pass, any visas that give you 5 or 10 years, even if they are renewable. Of course, there's a danger that at some point you don't get it renewed, and then if you have to leave, whatever else happens. But I think under current domicile rules, as long as you have some kind of visa to be there and remain there, and you've been there for a certain amount of time, you should be able to. And again, there's so many different bits that could pull you in, but PR isn't necessary. Of course, it would be a very big tick rather than having a shorter term visa, but not specifically a necessity. And again, that's why this is maybe changing. Yeah. And any other questions? Yeah.
Yeah, I just have one more specifically from my perspective. You spoke about this inheritance, £325,000, right? Can you just dwell into that more deeper? How does that work? How do you track it? And is there some sort of reporting that is necessary? So I just use an example. If someone is being gifted or given £1 million, okay, and does it fall under inheritance?
Okay, so inheritance tax, UK.
Reset every 7 years.
So UK inheritance tax is all based on the person who owns the estate. So the person making gifts or with the estate, rather than the beneficiaries of the estate, in terms of how it's assessed. So if and it's currently based 2 ways. So if you're non-domiciled, but you have assets in the UK, those UK assets are subject to UK inheritance tax. Everybody has it's called a nil rate band of £325,000, which is exempt. The first 325 is exempt. After that, there's certain other exemptions. Right now, there's a main residence nil rate band, which is an extra 175. So in theory, as an individual, you could gift up to £500,000 without any tax, and everything over and above that would be 40%, subject to some other allowances, small ones. If you make gifts before you die, in the 7 years before your death, those gifts are also included in the value of your estate. So in the example you gave of if you're worth £1 million, then you have some exemptions up to 500, depending on if you have a property and only if that property goes to direct lineal descendants, children, grandchildren. Everything over and above that would be subject to 40%. Plus, if you've made any gifts to someone in the last 7 years, that would be added on. So if I 2 years ago gave away £1 million, again, this is if I'm currently UK domiciled, subject to UK inheritance taxes. If I gave someone £1 million 2 years ago and I die, and my estate is still £1 million today, my estate for inheritance tax purposes is 2 million because I haven't survived for 7 years after that gift 2 years ago. This is for individuals that have worldwide assets would be subject to inheritance tax.
There's a sliding scale.
Sliding scale, which comes down after about year 4. It goes 80%, 60, yeah.
Sort of drops down.
But if you are non-UK domiciled, so let's say you're Malaysian, you have assets in the UK, it's only you
Assuming the assets are based in Malaysia, giving to someone who's a resident in the UK. Yes.
So if you pass away and you have Malaysian assets and you're Malaysian, there's no UK inheritance tax on those assets that are being received into the UK. Once
it's unlimited.
Unlimited.
Currently, yeah.
Currently, yeah.
But is there reporting? Is there something that you need to report?
No, they wouldn't have to do anything about it. It's currently exempt. But if you look at other jurisdictions, in particular the rest of Europe, then there's a gift tax in place. Ireland, for example, as well, where it's not the estate that pays the tax, like the UK. It's the recipient of the gift that pays the tax, and the tax rates deviate between how close you were to the deceased, so whether you were a son or spouse or whatever, at relatively low tax rates to higher tax rates where the receiving party is further distance from the individual that passed away. So that's again a tax system that's already exists, and therefore it's very easy for other countries around the world to look at that and say, well, we could just lift that and drop it into our current regime. But at the moment, it's okay.
Just so question aside from this, I understand that foreign spouse are subject to full 40% tax? They don't have the benefits of UK status?
There are restrictions in terms of how much you can give a foreign spouse. So at the moment, you've got gifts between UK domiciles and UK domiciles are unlimited. During lifetime or on death, everything can pass over free of tax, and also capital gains tax. But where for inheritance tax purposes, the maximum amount that can pass over is 325,000.
So you can add that to your other three.
Yeah.
Yeah. So you've got the nil. So you've got the nil rate band of 325 plus it's called the spousal exemption, which is an additional £325,000. So if I have a non-domiciled spouse, I can gift them £325,000 and that's during lifetime or upon death. So if you've made lifetime gifts, that is technically already used up. Plus, I have my nil rate band of £325,000.
And there's no sort of steady amounts away.
Well, you can keep making gifts every 7 years.
So the 7-year rule would apply to gifts I make to my spouse if they're non-domiciled. So if you made a gift and then 7 years pass, your spouse exemption kind of comes back because the gift is a potentially exempt transfer. 7 years on the gifts. Where else was I going to? Yeah, that's.
It used to be 55,000, and then it was increased to 325,000.
Yeah, well,
it's like everything. The burden of proof is on the taxpayer and not the tax authority. So you can be challenged, and then it's really important when people look at kind of planning around these issues that their estate is fully aware of what they've done. Their executors, because they're the people that are going to be having the conversations, if necessary, with tax authority, and not the individual.
But in terms of the gift to your spouse that we were saying before, one of the other exemptions, again, which is always underutilized, is the gifting from excess income. So if your excess income is significant, that can constantly be going across to your spouse in your spouse's name and be fully exempt under that excess income exemption. And again, that asset can go straight into trust without triggering other taxes, which I don't think we need to get into at the moment. Yeah.
You missed a few comments there, but I think about myself and Carol, we've been out in the UK for a long time, but if our beneficiaries are in the UK and we're out of the UK and all our assets are out of the UK, and we want to pass on our beneficiaries in the UK,
Yeah.
how's that going to work?
So again, right now the beneficiaries, assuming there's no inheritance tax due upon death, the beneficiaries currently there's no tax to them on receiving the asset, unless it's a pension and death is after 75. Then it's taxable as income tax. Currently.
Even if it's coming from the outside of the UK into the UK?
If it's a pension, yeah, under UK pensions. Yeah, currently, but what Neil was saying earlier is that in some countries, the recipient pays tax on, say, a gift received from an estate. That's not in place at the moment in the UK, but in some countries it is. So right now, if my estate is not subject to inheritance tax and my beneficiaries are in the UK, they can receive all the assets without any tax implications. If I've got a UK pension and I die post 75, they can receive that pension, but they pay income tax and everything out of the pension at their tax rates. Again, currently. Yeah, sorry. Yeah.
You know, the old way of this domicile issue, there used to be this term intention to return that the taxman was always barking onto me about. And U.K.Tax would say, if they think you have an intention to return, then, I don't know if it's still the same, then they could sort of wrap you under this whole IHT thing.
Yep.
Yeah.
Is that still the same?
Under the current rules, if you've got a clear intention to return, then yeah, I mean that's what happened with Richard Burton, wasn't it? Where he was in Switzerland for most of his life, and he said he wanted to be buried in Wales, and that was enough of an intention to bring his worldwide estate within the scope of inheritance tax on death. And
the other point here is that when someone passes away, so just had one recently, a guy, British guy in his 90s passed away in Singapore. He's been in Singapore since the age of 19. He had a retirement property in the UK, in Henley, and it's in a retirement village. So it's £1 million property. So currently that property, he's written intention to say, I'm Singapore domicile of choice. Now, when you go through, the executors of his estate have to complete forms for the UK because he's got a UK-based property. That property is in a retirement village. So there could be an argument that was your intention to go back and retire in the UK because of where it is. Again, right now, the solicitors are dealing with this, but even on once you pass away, there's so many extra forms you have to complete, and on those forms is completing what's your worldwide assets and X, Y, Z. But yeah, this is an example of someone who has been outside of the UK for like 70 years, but still potentially could fall in because the property is in a retirement village. So does that mean that I've had intention to leave, and how often did I even go there? But if it's a retirement village, are you not going to go back and live there in the future? I don't know. It's
There's another example of somebody who rented a garage to store belongings, and that is interpreted as
Stored stuff in the UK, yes.
Yeah.
I wouldn't surprise me.
So again, hopefully the new legislation clears up a lot of these things, and they say under the residency basis, if you've been outside for 10 years, if you've got no assets in the UK, hopefully it's exempted. But one thing I guess is it seems to me that it's less attractive than it's ever been to keep assets in the UK, whatever they are, whether it's property, whether it's whatever else. Particularly, I guess, if you're using that for an income, and you're paying tax on rented income in the UK, in theory, you could sell that property, move it into an investment pot, just have it very, very low risk, even if it just yields interest. That interest is not going to be taxable because it's outside the UK, and the assets can be outside the UK. So we are definitely seeing more and more people kind of with property, particularly in the UK, looking just to sell it, remove yourself from all of that burden, and take it elsewhere. Yeah. Any other questions, or has everyone had enough of tax yet?
Never.
Yeah, we good. Hopefully that was useful. I think there was a lot of information. Again, there's so many things we don't know. There's a lot of things that we know are going to happen and are likely to happen, and a lot of changes are coming. There'll be a lot more clarity on the 30th of October when all of that happens. We're available for conversations before and afterwards for anyone who's got questions. We're also going to be around here for the next few hours, probably to grab a drink. So if anyone's got any individual questions, come and grab us, grab anyone else, your current advisors. And yeah, if you've got any questions following up, just come back to us.
So I got one more again.
Yeah.
But you guys, you have products that sort of help people to try and reduce their IHT burden or whatever else it is. But are you going to be looking for new products, waiting till after the 30th of?
So I mean, I guess the products themselves become less relevant in terms of a lot of the solutions we have now. You can use them with or without trusts. So you can set up an investment account in your own name. You can use that vehicle to wrap in a trust for inheritance tax efficiencies. The vehicle and the structure itself are still going to be relevant even without the inheritance tax wrappers to it. So it's still not going to be in the UK currently. We do use the Isle of Man as a jurisdiction. We use Jersey. We use Guernsey. We use others. The whole point of a lot of the reasons for these jurisdictions are that wherever you go in the world, you can continue to hold them. You can continue to add to and take from them. So, of course, if there are new things coming up, we'll have our ear to the ground, be looking at them. But a lot of the solutions we currently use are still going to be as relevant as ever.
Yeah. So if you start something now,
Yeah.
and then they change the rules,
Yeah.
do they usually sort of backdate those rules, or they can't touch that?
Not really, unless there's a real perceived view of abuse. So the last time I saw retrospective legislation coming in for around inheritance tax was, if you remember before, I talked about these things called excluded property trusts, where non-UK domiciled individuals could create the trust structure, and then the assets would remain outside of their UK estate indefinitely because they set it up as a non-UK domiciled. I believe there were people selling excluded property trusts to UK domiciled individuals who'd been long-term non-UK expats, who then moved back and claimed that their assets were excluded, and that was, I guess, a step too far, and that was legislated against with a view of you could never have done one of these in the first place. Therefore, what you've got now can't remain. So it's lost all of its effectiveness for IHT. And was viewed as being a transparent arrangement. But I think typically where someone set something up under the rules that apply at that point in time, and it's done without any perceived view of avoidance or evasion, then typically they stand. Yeah.
And again, yeah, there's probably some structures which right now we might not recommend because there's maybe going to be impending changes. So there's things that and certain pension schemes, so like qualifying non-UK pension schemes, for example, currently you can put in effectively an unlimited amount into them and they'd be exempted from inheritance tax. However, there's restrictions on how you can draw them down. So right now, I'm not going to be recommending someone set one of these up if it's not going to be relevant in a month's time because of the restrictions on it. So yeah, I guess going back to the what do we have and what may we use, there's things that we definitely wouldn't set up right now because it may change in a month. But there's a lot of other things which we can set up, which will carry on to be fully relevant. Yeah. All good? Anyone else? Perfect.